Why do so many businesses fail to sell? In most cases, it comes down to preparation, buyer confidence, and risk. Most businesses fail to sell because they're not ready for sale. The thought process of selling has not been given the time to be reviewed and looked at and prepared then for sale. Preparation looks like a plan. What does a business now need to do to make it sale ready? So for things, for argument's sake, of an overview of the business, and I think the best question to ask of the business is, why would somebody buy the business? And then what do you then therefore need to do to answer yes to that question? Buyers tend to walk away from businesses because it's not what they first thought it was. There's what's called an agreement, a heads of terms, so that both parties will have conversations, information will be shared, an overview will be seen of the business and an understanding. But the problem lies is that can break down throughout that process because it can quite take some time to be able to then complete that transaction. So things come out of the woodwork, which it shouldn't do really. So it's therefore then back to preparing the business ready for sale, business readiness. The reasons why a buyer would walk away is because what they're finding in the due diligence element of the process is causing them red flags. Things like contracts that were discovered to not be as lengthy as they thought they were. There's a lot of focus on one particular client for that business, so all their eggs are in one basket, which heightens the risk. So all these elements can start to increase the risk factor of a buyer. From a sales perspective, what you need to look at is what are those potential red flags in that business. These red flags can consist of agreements with customers and suppliers and how strong they are or weak they are, or how contractually bound they are to trading with one another moving forward, how focused it is, how varied that focus is across that sector, that risk. And also then going through the due diligence yourself, making sure that you've gone through employment contracts, landlord agreements, all these sort of elements of how a business needs to trade need to be checked and documented in a way where it helps tick those boxes where those red flags can be. Most business owners have not sold their business before. They've not been through that process. So trying to get the heads around a value of that business can be quite a wide-ranging reason as to why they consider the value of the business is X. It's been their life. They've built it. It's a startup. They've spent 20, 30, 40 years in this business, and they see a value to that business, and that value, adds to that figure of X. But also they see that the relationship that they have with that sector, that industry, there might be a barrier to enter that sector, so therefore then it can add value. And it also might be that the contractual obligation that business has got, yet again, can even add more of a value. The IP element of the business, because there's all these factors that business owners believe to be a value, and in circumstances they can be a value. One thing we come across quite a lot is stock. People believe that the stock is an added value to the value of the financial metrics of the business because it's an asset. But stock is actually the mechanism in which the business utilizes to work and to be a business. So unless it's quite extreme stock and it's got a value that sits outside of that, then predominantly that's not factored into the value of the business. Predominantly the value of the business is rated from an EBITDA perspective, earnings before interest, tax, depreciation and amortization, and then a factor is added to that from a measurement of how companies in that sector have sold in the previous years, and that multiple is then applied to it. So that will give you a baseline figure to the business, and then from that we can apply other elements of that business, how it trades, barrier entry, what the appetite is to buy the business, because that's also as a play into it. So is the market shifting one way or the other way? So is your business quite a bespoke business, and is there quite a lot of interest in acquiring your business? Is your business the opposite way around? Is it one of many, and therefore there's not many buyers that want to buy it? So all these factors are looked at from a perspective of value. But the business owner does tend to overvalue their business. Why? I don't know. Maybe it's because of or a business sold not so long ago for this amount of money, or maybe somebody in the pub told me this, and maybe the accountant have said that. But reality is the business is only worth what somebody's prepared to pay for it. Clean financial records are so important because that's predominantly where red flags occur. So doing the due diligence and getting that all in place prior, and having understanding as to why, what we tend to see is there's no description to the financials. So it's important to add that narrative to that figure, because that is a potential question that's going to be asked. And if you can prepare that in advance, when it comes to that conversation of back and forth, then there's a reason behind it. There's a purpose and why that figure was the figure and so forth. And that can be explained easier, should I say, than just a figure that a buyer has to try and get an understanding to. So it's important to get the financials, one, right, and then two, descriptive, so there's a meaning to that figure. And then also on presentation to the buyer, then there's a narrative as well, as to an overview as to what these financials are saying and doing. And also what we tend to do is also look at helping the business owner to prepare a bit of a statement. So for example, in year 23, 24, the industry was struggling through this trend or that, or this had an impact to the business and so forth. So the more information, descriptive information can give around the financial numbers themselves, the better that will help any sort of concern relating through that process of purchase and sale. The three main reasons why a business fails to sell. The first part of that is overvalue. So if you're trying to sell something at overvalue, then there's always and if you're trying to do that, then you've got to have a lot of support that supports that value. But what you tend to find is that for one reason or another, a business owner has decided that that's the value they deem the business to be, and then try and sell the business at that value. What then tends to happen is that it doesn't sell, and months go by, and they've been talking to this person, that person, and nothing seems to happen. So what then tends to happen is a realization starts to take place as to, well, actually, although the true value of this business is what somebody's prepared to pay for it, you've got to bring that alignment to that to be able to have that conversation. So what we tend to find is that it's a long time sat in the market because whether another broker or whether an accountant or whatever the case may be has deemed the business to be of this value. That's the first one we tend to come across a lot. The second one is that the businesses aren't actually ready to be sold. There's a lot of preparation needs to be put into place to be able to do that. They're very dependent upon the owner. The owner actually is so ingrained in the business. For example, the owner can pretty much know all the contracts that the business has, all the sort of suppliers, and is very much across the whole relationship element of that business. And that, yet again, as an effect, because that highs the risk. Because if the owner is so ingrained in that way and they're going to exit, then where's the replacement of that? Because it's been their business from day dot. Everybody knows who they are, the business and so forth, and now you're trying to move that dynamic so you're not a part of that business anymore. Therefore, then how is that going to affect all those relationships that business has had, all that trust that you're now going to impact? So that, from an investor's perspective, is a risk, and it's how then you mitigate that risk. So getting your business prepared to be sold is a part of that mechanism that you'll go through, so that you're reducing that risk element from the buyer's perspective. The third one, what we come across is the industry, the sector. How is it being impacted? Is there a higher risk in that sector that can cause concern? And these sectors, we're seeing quite a bit of it now with AI, how buyers are looking at the business and thinking, well, that is a risky business to be in now, because how AI is currently affecting that sector, that industry. And what they're looking for also is how the business has adapted to the technology or not. And so there might be an opportunity to buy the business to adapt it, but what they look for, what we're seeing, is then they're looking for that adaptability has already taken place, because yet again that mitigates risk. If technology is going to have a big impact on this particular sector, then the risk goes up. And from a buyer's perspective, it's all about mitigating the risk. Really, I think when you've formed a business, you should be looking to sell the business. So you should be what's called exit ready. It's an element of your business that we should all do and have, But we just don't, and that's just, a lot of businesses don't go that way. A lot of the focus is on growth, and it's a different direction. But if you were to start to build into this element of your business now, today, if you start to go, okay, I'm going to now sell the business, and what do I now need to do to get that business ready for sale? You may not want to sell it in the next 3, 5, 7, 10 years. But what that does do is it enables the elements of getting the business exit ready to be built into place. And it enables, when the time does come, because presumably there's going to come a time when that business goods need to be sold, whether that's selling it to the staff, whether that's selling it to a competitor, whether it's selling it to open market, however it is that you see that this business will be sold, doing the preparation now with that in mind is going to save you so much time, headache, and it's actually going to get your business in a far better place to be able to, one, sell quickly, two, get the right, get a good value for that business, and even your legacy. If the business is ready and built and solid for another business owner or a buyer just to come in and sort of develop that and bring another level of expertise to the table to be able to expand that legacy. So when is the time to get your business exit ready? Well, it should have been when you started it. If selling is a part of your business plan, then get advice early so you can start to put the plan in place.